Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. So, welcome to the Special Situations cast. Today I have a very special guest in Ian Bezek. Sorry, is Ian or Ian?
Ian, that's right.
Ian Bezek. And he runs Ian's Corner on Seeking Alpha. And he also contributes to Value Edge. Did I say that correct? Is Value Investors Edge?
That's right.
Yeah, cool. And I'm so happy to have you. Welcome, Ian. Ian? Oh,
Ian,
sorry.
yeah. No problem.
How are you?
I'm doing well. Thank you. I'm happy to be on your show.
Well, really, really happy to have you. I just wanted to start off this conversation by asking you, how did you get to run Ian's Insider Corner, which is a research service? And I know you also worked at quite a famous hedge fund, which is called Kerrisdale Capital. And so I'm very curious how that all came about.
Sure. So out of university, I started writing reports on Chinese companies that had listed on the US markets that seemed a little suspicious. Some of the financials seemed too good to be true. And so I published some of these reports, and when a couple of the stocks in question dropped, and so a hedge fund in New York contacted me and said, "Hey, we're working on this as well. Why don't you come work for us?" So I did that for a few years with them. It was a great time, but I didn't want to live in New York forever. I don't like big cities, the traffic, pollution, cost of living, just not for me. So I saved some money, said, "Hey, I've always wanted to learn Spanish and travel." So I spent a year traveling South America, and I loved it so much that I've stayed down here ever since. And obviously I needed something to do, so I said, "Hey, why don't I take what I learned from being a hedge fund analyst and offer that to the people on Seeking Alpha? You can have your own kind of analyst at your side for a reasonable price. I answer your questions, give you ideas, insights here on South American stocks in particular." And that's where I am today.
Cool. So you were actually involved with the whole era of the China, that's covered in the China hustle.
The what, sir?
There's this movie, The China Hustle. It's called a documentary.
Oh, sure. Yeah. Yeah. I knew quite a few of the people involved. I wasn't in the documentary, but
Okay,
it's a good movie. It's worth watching for people.
Not be in it?
Nah, it's all right.
Okay.
The people that are in the movie deserve the spotlight. They took the most public criticism for their positions at the time. So
Sure.
and it's worth watching the movie. It's well done.
Yeah, it's definitely worth watching the movie. But I'm curious, what companies did you get involved with at the time?
The one that kind of launched me to my career, I got quoted in Reuters and a few other news sources, was on one called Yangyi, which was a Chinese fertilizer company. And I looked at their reports and just said, there's some stuff here that doesn't make sense. Like, they're saying revenues have doubled, but they haven't hired more employees. Their accounts receivables aren't going up. Their key customers keep changing every year, but their gross margin never changes. Just some stuff that makes you wonder, like, what's going on here? But you had people recommending the stock saying, "Oh, it's trading at a 5 PE, it's really cheap." And I just said, maybe you should stay clear of this one.
And how did you learn to look at those things? Like,
I studied economics in university, but I was always more interested in finance. So I took part in our stock picking club at the university, and it's just always something I've been passionate in. I went to college during the financial crisis, and so I'd be in class and they'd be saying, "This is how economics work," and then I'd be looking at the stock market and saying, like, "This is not how economics works." Like, I was taking a money in banking class, and the professor wasn't discussing, like, all the banks are failing. He's like, "This is how the banking system works." So I'm like, well, obviously I need to go learn what the truth is. So it's just self-taught mostly.
okay, cool. Yeah, because I don't think everybody who's been taking economics um, will have that desire to find those those frauds, and it's really cool that you that you were working on that stuff at the time, and it got you a great job. So maybe to move back to today. And you mentioned you're in South America, and um, you went there to pursue some entrepreneurial opportunities. Are you still pursuing those as well, or what were those?
Yeah, and it's unfortunate timing with the virus and everything, but I've been looking into buying some properties here. I believe there's significant arbitrage between the prices that Colombians will buy properties for and the price that foreigners will rent them for. Uh, just until recently, Colombia had fewer tourists than very small countries in Central America, like Guatemala and Costa Rica have more tourists than Colombia. Like, Colombia still has this reputation of being very unsafe and drugs and whatever. Netflix is always making new movies about how dangerous Colombia is, but that changed 20 years ago. And so I believe there's going to be a big tourism boom, but properties are still sold in pesos. They're not sold in dollars in many cases. I believe the prices are just wrong. And so you can accumulate properties, and then there should be significant upside in renting them out to foreigners. Uh, but we'll see. There may be even
Cool.
better prices with COVID because the economy is still shut down here.
Yeah, sure. Yeah. Is there like, do you think is there any catalyst for like tourism to start for real, or is just grinding away, getting a little bit better year after year?
In Colombia in particular,
Yeah.
uh, yeah, I think the economy here is based on oil, and so people are very pessimistic now because who knows when oil will come back, and that was 50% of exports, and so our local money has devalued very sharply, even from 2014. Like, obviously, it's devalued again in 2020, but it's down more than 50% now since 2014. And the values are just incredible. Like, you can a taxi ride around Medellin's $2 or $3. You can get very nice meals for under $10. It's like it's very nice. It's safe, and people don't realize it's safe yet. And so I think that's you're going to see a lot more tourism promotion here. So the government has to
Mhm.
figure out what do we do now that oil isn't working.
Sure. And are you in the capital or different city or even in countryside?
I'm in a small city now, but if I buy properties, I would go to somewhere else.
Oh, okay. To like a major city or something. Cool. Sounds very interesting as well. But yeah, I wanted to talk to you today about your investment ideas. I noticed that like several of your more recent write-ups, they partly hinge on a COVID recovery. I was curious what are like your working assumptions of the path forward from here regarding the virus. I don't expect you to be, expert, of course, but I think we all have to work with what we have, and yeah, I'm just curious. What are your thoughts?
hmm Yeah, I'm definitely not a virus expert. As it turns out, my wife is a biologist who studies tropical diseases, and even she says we don't have enough data to make any concrete assumptions. She'll look at what the politicians are saying and just say there's not enough evidence to either agree or disagree with what they're saying. And so when my wife doesn't know, I certainly don't know. Uh, that said, yeah, we have to make assumptions. I'm going with the view, I believe it's Moody's, who says that the air travel will return to normal in 2023, which seems like a reasonable baseline assumption. And so that's what I'm working off of. And with that in mind, balance sheets are most important. The companies that stay in business are worth a lot more than the companies that are going to have to dilute or which may go bankrupt. And so my travel recovery plays are mostly in airports and other related stocks where there's very little debt. Like, my top position is in Centro Norte, which is a Mexican airport company, which has less than 1 times debt to EBITDA. And
Yeah,
so
I really want to talk about that one because I think it's super interesting.
And so
Please continue.
yeah, I think it's a great pair trade to set that up against something like an American Airlines where they have billions of dollars of net debt. They're losing 40, $50 million a day in cash burn. And the only long thesis is that the government is going to give them more money, which I just don't think that's I don't think that's
More
something you
money
pin your
for
hopes on
France.
when it's not going to be profitable again until 2023, 2024. Like, how long is the government going to be willing to save a dead company? And so I think it's very attractive to take a company like your airports or your luxury retailers where the balance sheet's fine, you're just losing 2 or 3 years of profits, as opposed to the other side of the trade where you have a solvency problem.
Yeah, I totally agree on that. And then your thesis on Central and North airports, I thought it was very interesting because I kind of like the airport, your sort of infrastructure assets. You know, you can build new ones, sort of local monopolies. Often they can tax the retail that they put in place, and that's, you know, sweet retail usually. So I was curious. Yeah, please tell us about Central North Airport because I thought it was a pretty good one among the airports.
Sure. For those that aren't familiar, it's the airport operator for northern Mexico. Its flagship airport is Monterrey, Mexico, which is the country's third largest city. It also operates 11 other airports. However, Monterrey is half the revenue, by far the most important
Do you
asset.
happen to know how many people live in Monterrey? Or
It's
don't you?
5 or 6 million people now. And it's of crucial importance because it's the center of the country's manufacturing region. Um, all of the key highways and key rail links that go between the US and Mexico City in the south pass through Monterrey. You have, it's the logistics hub. You have, I believe, 80 different multinational companies there. You have many of Mexico's largest firms there as well. And so it's been attracting more and more direct flights from the US. Cities like Detroit have offered direct flights there because the auto industry, the executives want to see their factories. Uh, so you have a lot of direct travel, business travel, which I think that business travel comes back. I know people are bearish on business travel. However, I don't think you can run auto factories and healthcare facilities and the sort of heavy manufacturing that occurs in Mexico. I don't think you can run that over Zoom calls. I may be wrong, but I think it's a very different class of business travel than what people are worried about, where it's just people jet setting to conferences. Uh, so I think that's strong. And then obviously you have all the skepticism around China now because I don't know, everything that's happened with the virus, and the US is very concerned about espionage and trying to convince its allies not to buy 5G from China. And if I were a manufacturing company in the US or Canada, I certainly wouldn't build a new factory in China now. And so people are having to look at alternatives, and Mexico's right next door to the US. You have a large, relatively well-educated population base, great infrastructure. I think it's a big story for the next decade.
Yeah, I thought it
And
was,
it's
you know,
already a phenomenal business, 70% EBITDA margins. They pay out all the cash flows, dividends, so you get a 4 or 5% yields most of the time. That grows at 10% a year. Management has been very kind to shareholders. I know that's a big concern with emerging markets, but they've been publicly listed for 15 years now, so they've built track record as a credible company.
cool. Yeah, and I thought it was. I totally agreed with you on the like how Mexico would be a beneficiary of the U.S.-China tensions continuing. Um, how are you looking at like if Biden wins the election? Do you think those tensions will abate, and will that hurt the thesis, or you're not too worried?
Yeah, that's a good question. I think that would slow the manufacturing buildup in Mexico, which would be a negative. On the other hand, I think Biden winning would probably cause more immigration to the U.S. One of the big drivers of traffic is friends and family. Uh, I don't know about Monterrey in particular, but the city I lived in Mexico, 25% of the population had lived in the US at some point in their life. And in particular, like everyone had lived in Texas. And so there was a huge amount of traffic, just people flying to Dallas, to Houston, to San Antonio. And so the more immigration you have, this huge Mexican American population, they're going to want to travel, visit friends and family, show their kids where they grew up. And so I think just the integration of the US and Mexico as friendly allies, in the same way that there's tons of US to Canada travel. I think you'll see tons of US to Mexico travel. And that will accelerate if Biden's elected, because people will feel safe in traveling north again, whereas Trump has obviously been a deterrent for immigration.
Sure. Also, maybe you mentioned it already and I missed it, but this airport has like unusually low debt levels, right? Because airports often carry quite a big load of debt because it's a nice infrastructure asset, predictable cash flows, and you can put a lot of debt on them. And this one doesn't. I was curious about that. And do you think that will ever change or not really?
Yeah, it's interesting. There's, for people that don't know, there's 3 listed Mexican airport operators. There's one that runs the Cancun tourism airport, and then there's one that runs Guadalajara, which is the second largest city in Mexico. And all 3 have very low leverage, which is very unusual. Like the European operators have very high leverage. The Sydney airport just had to raise money because they were over leveraged. And so that gives a strategic advantage to the Mexican airports right now because they don't have any solvency issue. As to your question, why they don't use more leverage, my guess is that they borrow in pesos and interest rates have still been 6 or 7% there. And so maybe they don't view that as cheap money in the same way that a European airport borrowing at 1% would say, why not? Money's free. But I don't have any, I'm not aware of management saying that they're planning on changing their leverage.
Right. Yeah, I think you're exactly right there, but that should shape up some opportunity for like an acquisition from like a larger European organization. But usually people don't like their airports taken over, right?
Yeah, the contract specifically says that 51% of the airports have to remain in Mexican hands, so it could only be a minority interest.
Yeah, I think that's quite common with the airport stocks that they have some kind of state influence or province or whatever. You have some interesting other Mexican investment ideas. Like, let me see, which one was it? It's a chicken producer in Mexico, a chicken and eggs.
Bachoco, yes.
Right. Yeah, can you tell us about that one?
Sure. Yeah, I think Bachoco is what it's named. It's the largest chicken producer in Mexico, one of the top 10 globally. It's now a major player in the US as well. A third of revenues come from the US. And I believe it's a classic deep value stock that's hiding in plain sight. And I know deep value is not attractive nowadays, but some people still are willing to give deep value a look. And so I think it's very appealing. The stock's trading, I'm not sure when you'll air this, but at or slightly under tangible book value. And half of that book value is straight cash. They just hold Mexican treasury bills. So you have a market cap of $2 billion and $1 billion of cash with no debt. So there's extremely limited downside risk. And on the upside, you say, why do you want to own a chicken producer? They're generally commodity businesses that aren't great investments. But in this case, the margins have remained higher in Mexico than in the US. So that's been one positive. And 2, because they don't have leverage, they're able to buy out competitors every time the cycle falls, excuse me. In 2011, they made their big US acquisition when the US companies were going bankrupt. And they just made another big acquisition this year now that prices are low again. And so they have this huge cash hoard that they can deploy counter-cyclically. The business earns 10% returns on equity, which isn't great, but hey, when you buy book value, you don't need fantastic results. It's grown earnings 7% a year over the past decade, which when you're buying at 10 times earnings now, 10 times earnings at 7% growth is quite nice. They paid a 2% dividend, so you get something for owning the stock. I think it re-rates whenever Mexican stocks go up. Mexico's been in a bear market since 2013. It's down 50% in dollar terms over 7 years. So it's just, no one's looked at the market. I think you have stranded stocks like this. They're not part of ETFs. Nobody's paying attention, but hey, you're getting it at book value. And half of it's cash. So even if the business deteriorates, it's hard to lose money. And the last time the chicken cycle turned up in 2012, the stock tripled in 2 years.
Cool. Do you have any idea? You mentioned that the margins are better than US producers. Do you know why or?
Better in Mexican producers. I think it's just that it's a more local market. In the US, you have a few players that have scaled up and use a ton of debt, and so they're very competitive in terms of and also the Walmart and other grocery stores control more of the market, whereas Bachoco has plants in each Mexican state, and they sell to. I think they're better control of the supply chain because they're not. Uh, Sorry, I'm
The
rambling, but you get my
yeah,
idea.
yeah, sure, but like you mean that maybe there's not as much power with the retail chain.
Hmm.
Okay. The interesting. I like I like this this idea a lot. Um, we kind of dove straight into your ideas, and before I even ask you to explain like what you like in investments and what your overall kind of strategy is, but we already noticed that you mentioned a couple of investments with very low debt levels. Is that a coincidence or does it play a major role? And I also noticed reading all your stuff that um, you gravitate toward bank stocks. You're interested in those, shipping, and spirits, alcohol. And yeah, I'm just curious, what makes you tick, or why do you like those kind of ideas?
Sure, I should say on shipping that I'm interested in that because my friend Jay Mintzmeyer has an excellent service covering shipping, and I think there's great trading opportunities there. But I don't own shipping stocks as long-term investments. I think that's more special situations and catalyst-driven opportunity. On the banks, I think banks in Japan and in Europe have been terrible investments for a very long time, and people have assumed that due to demographic factors that the same thing is going to happen in the US. And I don't believe that's the case. Population is still rising in the US. The economy is growing fairly quickly. It was until COVID. You still have net immigration. I believe the credit system will continue to grow in the US and banks will prosper, but people are starting to price them at significant discounts to book value, which implies that the business model is in trouble long term. And I simply disagree with that view. In particular, some of the regional banks are reporting excellent results this year. We're having another housing boom. Everyone wants to get bigger houses or move out of the city with the coronavirus. And so you're seeing many regional banks reporting 75, 100% growth in mortgage banking revenues, record profits, and their stocks are 52-week lows. It's just, if you're going to bid up everything else to all-time highs, why not buy the stocks that are actually reporting record earnings?
Yeah, there's certainly some strange discrepancies in the market. Well, like with banks, I'm not an expert on those, and I'm pretty worried about like the fallout of COVID. Um, what if some of the government assistance ceases? Um, how are you thinking about that? Will they see a lot of defaults, or you think it will be okay, or they can manage through it?
Yeah, I think people need to look at each bank that they're considering on an individual basis and ask, what's my exposure here to commercial real estate, to energy, to construction? I think a lot of banks are going to face big problems, but I don't think it's a 2008 where everyone is just going to get hammered. I think the banks that are mostly mortgage lending and banks that have been conservative will be fine. But I think the market is just pricing, just people are so scared from what happened in the financial crisis that, yeah, I wouldn't buy a heavy construction lending bank now. I wouldn't buy an energy bank. I'd be careful with the national banks because they have lots of exposure to consumer credit, to auto loans. Stuff like that could be more problematic. But I believe your typical regional bank with mostly housing exposure will be fine.
So you kind of love the regional ones, but I noticed you're also interested in Wells and investing in Wells Fargo, which I think we have to talk about if we talk about banking. Um,
Yeah,
you think national banking could be in trouble, but Wells Fargo not so much, or it's just too cheap?
It's too cheap. It may be a value trap. It's certainly been one of my worst performers for 2020 in terms of my performance attribution. I believe in the CEO, Charlie Scharf, though. He's done a tremendous job in his previous jobs, including Visa. I think he's a great guy to fix the company. And like you look at it compared to say JP Morgan, and JP Morgan's still trading at a high valuation. And I get that Jamie Dimon's an excellent CEO, but he's had heart problems. What happens after he leaves? Normally banks revert to the mean at some point. It's very rare that a national bank will continue to be the star performer forever. Like Goldman Sachs was the king of investment banking, and now no one wants to own their stock either. So I think the question with Wells Fargo is, have they permanently destroyed their reputation with all the scandals? I don't think so, but I could be wrong. That's how I would lose money. But the stuff around the asset cap, that will get fixed eventually. The excessive legal costs will go away. I believe there's $5 to $6 of base earnings if they just return to how profitable they were prior to COVID once the legal obligations are gone. And so $25 for $5 or $6 of earnings is very attractive.
Yeah, and I think what sometimes, again, it's not my expertise, but I understand that there's a lot of regulation that's being dialed back, also under this whole COVID thing. Banks got a lot of additional regulation after the great financial crisis, and I'm sort of hearing that a lot of that is going away, or some of that is going away. Is it true, or it's not a big part of your thesis?
Let's see who wins the election in November before I take too strong of an opinion on where regulation ends up. If Biden wins, I'll be very curious to see if people like Elizabeth Warren end up in his administration, because that would say there's going to be much tighter banking regulations. But if he picks people that don't regulate, or if Trump wins, then there will be a lighter touch.
All right, interesting. Let's see. Something else that kind of related to your banking investments, but you're kind of a vocal Square critic, and I actually didn't know that you started out as on the short side. So I was a bit surprised that you were so critical of that company. I was curious, why do you think Square is so bad? It's a payment company. It's kind of a tech company. It's run by Jack Dorsey, in addition to Twitter, and it's kind of a darling of the market, right?
Mm-hmm. Yeah, and I think the company is a fine business model. I think it could be successful in terms of operationally, where I don't think the price makes any sense. People are trading it as if it were a software company selling for 11, 12 times sales. And even to that extent, many of the sales are inflated because they sell Bitcoin. They serve as a Bitcoin broker. But they count all of the revenues from Bitcoin sales as revenues, which is just weird. Like, imagine if Charles Schwab counted all of their stock transactions as revenues instead of just the commissions. So I think revenues are overstated. That's not to say there's fraud or anything there. It's just a weird accounting gimmick that is giving them more revenue than they've really earned.
Yeah,
and I don't.
It's possibly it could be related that Bitcoin is maybe classified as a commodity or something. I'm not sure about that, but maybe it's something weird like that with regulations.
Yeah, but in any case, a business on which they have a 2% gross margin, I don't think people should be paying 11 times sales for 2% gross margin. The payments business was fine, but it wasn't growing that quickly. Square stock didn't really go anywhere for years after its IPO. Now they've got the Cash App, which is interesting, but I haven't seen the monetization there. Just doesn't justify a $50 billion market cap, not even close. Perhaps it will become huge, but like right now it's like advertising on Animal Crossing, like just random games. Like, it feels like a kind of a fad. Like, in this market, like if Farmville had been public years ago, like it would have been a huge stock. But I'm not sure how sticky these things are. Like once you stop giving people free stuff to download your app, how much of the base will stick around? Now they're trying to transition into banking. They got a banking license. They're going to start making loans, but I think that's going to drag down their valuation because, I mean, who wants to pay 11 times sales for a company that makes loans? They're making subprime, not subprime, sorry. They're making payday loans to their customers, charging 60% interest rates, which is just not the sort of business you associate with a company selling at 11 times sales. So I think it's just misunderstood. People are dreaming of it being the next huge company, and it may be a successful company, but it's not worth $50 billion today.
Sure, yeah. I think there's an example of one of those apps. I think it was with the Angry Birds one. I think that company got a huge valuation for a while, and I think it came back down to earth at some point. But I actually don't remember the ticker. So something. One more thing. Well, and what are your feelings about Dorsey running like two companies at the same time?
Yeah, I think it'd be better if he had more help. I think it's hard enough to run one large company, and so two large companies is difficult. You saw the huge hack in Twitter, which fortunately it didn't turn out to be much, but that could have been devastating to lose control of some of the world's most powerful people. I mean, who knows what they could have started a war, or who knows what. So it's a glaring security deficiency there. And it's scary in terms of Square, where they've got all your Bitcoin, they've got all your cash, they're sending money around. And with crypto in particular, if people steal it, it's gone. There's no legal protection if people take your Bitcoin. So I think your one hack, like if that Twitter hack had happened at Square instead, stock would have gotten devastated, would have just collapsed. I think you need credibility, and I don't view Dorsey as a credible CEO at this time.
Well, that's a good point. That like the Twitter hack would have been like almost fatal for Square, possibly. That's hopefully his security is different there. So you've had another very interesting idea, which is called Empire State Realty, and this owns the Empire State Building, right?
That's correct.
And
And also around a dozen other office buildings in the New York City area.
But it's a huge landmark building, a historic landmark, sort of. I think it's maybe 100 years old.
It was built during the 1920s. I believe it opened in 1932.
Wow.
Yeah, it's often used as there's a skyscraper theory about the economy. Whenever a country builds a large skyscraper, their economy is about to crash, is how the theory goes.
Yeah.
And so that was the US version, because they announced the Empire State Building, I believe, in 1928. And then obviously the market collapsed in 1929. And then the Empire State Building had trouble attracting tenants for a decade after it opened.
Cool. Yeah, I haven't checked it recently, but I think that theory sort of checks out. So this sounds and this is real estate investment trust, right?
That's correct.
And why do you like it so much?
Yeah, I think the thing that people are missing is that it owns the observatory, which is it's a deck at the top of the building where tourists can come and view the whole city and take pictures. And it's a very famous attraction. Management has spent heavily to. It appears in many sporting events, like images from there, in music videos and movies. Like they've spent a lot of money making it the landmark for New York. Uber said in 2019 that it was the single most Ubered destination in the world, which gives you some sense of
Wow,
how
I'm surprised.
prevalent. Yeah, and so yeah, I think it's a one of a kind asset. Sure, some people have built other observatories, like Hudson Yards, which is a new shopping mall in New York, built a observatory, but they don't have the tradition. For what it's worth, Hudson Yards hasn't been a successful project so far. There's been a lot of vacancy and low traffic, and so I'm not sure an observatory attached to a struggling mall is really going to be as big of a competitor as the Bears are saying it is. But back to the broader point, I think the observatory is undervalued. I mean, you're looking at what $130 million a year, I believe, of revenues,
Mm-hmm.
very very high margin revenues, uh, and so I think that justifies a large chunk of the market cap right there. The value for luxury assets keeps going up and up, like sporting teams, luxury goods stores, anything that's one of a kind. I think it's worth more and more in
Is
the
it
world
sort
now.
of happening here? You see something that you see quite often is that like a smaller revenue stream that's actually very high quality gets slapped with the lower multiple of the whole thing. Is that sort of your...
Yeah, I think because it's attached to an office business that even before now, people were saying that office rents in New York were high, so there wasn't really much upside. And now, obviously, with COVID, we don't know when people are going to want to work in offices again. So far, the company's rent collections have been stable. They've been quite strong. However, who knows what contract renegotiations will look like. So there's potentially some significant downside on the funds from operations. Maybe the stock was at $20 a few years ago. Now it's at 6. So I'd say, and it's one of the lower levered REITs out there. So the market cap is dropping a lot. Means the enterprise value has dropped a lot. So I think it's
Okay,
priced in.
so this is another one of your lower leverage ideas. This you like good balance sheets.
Yeah, they were able to buy back stock in April and in May when most of the other REITs had to issue stock, or at minimum they had to step aside. But the CEO is contrarian. For years, he was saying, "We're not going to buy more properties in New York. We can't do anything. Prices are too high. We're just going to stick to what we're doing." And now he's like, "We're looking to make acquisitions. We're buying back our stock. We're on the aggressive." And so
Oh
I
wow,
like that from a
that sounds
capital
great.
allocator perspective. Yeah.
So he's sort of a Sam Zell of on a smaller scale.
Yeah, that's the idea.
Okay, cool. Yeah, there was one thing I wanted to ask you about that. It's first that I can't think of on the top of my head. I'll just check my notes. One sec. Um,
I think you asked about spirits, liquors, stocks at one point, and I didn't get to your question.
oh no, I absolutely wanted to talk about those as well, because well, I'm interested in general. Why do you like those companies in general?
Yeah, so uh, I view my investments in two buckets. I have one which is never sell, or at least never sell unless the company greatly strays from its business path, and then more actively manage stuff. And so in my category of stuff that I never sell, I love consumer staples. I think generally they look expensive because maybe they sell at a 20 or 25 times PE multiple, and people say the stock market should sell at 15 times, so they're too expensive. However, if you look at the long-term results from food companies, from chocolate companies, from liquor companies, they're incredibly stable, and you very rarely wipe out and lose your capital. So I believe that they're perpetually underpriced compared to what they should be worth, and particularly in a world where bonds don't pay anything. I'm happy to hold a Diageo, a Brown Foreman, these sorts of spirits companies as the equivalent of my bond holding, because I'm not going to sell them until I retire. And so why would I take 1% from a government treasury when I can get a 5% earnings yield from Diageo and get growth as well? I expect 7 or 8% growth on average from Diageo. So I view that as, I mean, you don't want to do this if you need the cash anytime soon, but if you're investing for decades, I don't see why you would own bonds when you can own a world-class company like Diageo. Now it's at 21 times normal earnings, which I think is a great deal compared to a market at all-time highs.
You rather have these things maybe yielding you 5% and swinging a little bit around instead of a 30-year bond that swings around a lot as well, but pays like, I don't know, 2%.
Yeah, because at these starting yields, I think you could easily lose 30 or 40% of your money on a bond, just as interest rates go up. I mean, you say, "Oh, I don't care. I'm going to own the bond to maturity," but I'm saying in effect, so I'm going to own Diageo to maturity as well. I have no reason to sell it anytime soon, and so I think the prospects are much better of owning an alcohol company that's brands that are 100, 200 years old. They have distribution in hundreds of countries. They're everywhere. I mean, it's it's like Buffett said with Coca-Cola, how would you attack this company? Even if you gave someone billions of dollars, I don't know how you would displace it. The moat is just huge. And yeah, people are like, oh no, it's too expensive because the market's it's a few turns over the normal PE ratio.
Sure, yeah, and you found kind of an interesting anomaly in one of the stocks, which is Brown Foreman, which is a class stock and a B class stock,
That's
and
right.
there's a huge sort of arbitrage there. Yeah, I'll let you tell it.
All right, yeah. So Brown Foreman is a family-owned company, and the family primarily owns A-class shares, which have voting rights. But the B-class shares were sold to the public and don't vote. However, there's far more of them because the family is pretty tightly held. Like the A-class is their source of liquidity when the family wants to sell and raise money. So the shares are not widely traded. They're on the New York Stock Exchange. They're available. They're just not widely traded. As such, they're not in ETFs. There aren't options on them. Like, it's just an illiquid market. Maybe it trades 100,000 shares a day, whereas the B-class shares, the non-voting shares, have 10 times the liquidity. So that's where all your traders, that's where your S&P index funds go. And so up until recently, they'd been trading at the same price, which arguably the A shares should be worth more because they can vote and the B shares can't. But whatever, they're trading at the same price. People say it's not going to get taken over because the family owns it. And so the family gets to decide whether acquisition would occur or not. So maybe the voting rights aren't valuable, but they're not. There's no negative value to owning a voting right as opposed to not having one. And everything else is equal in the share classes. The dividends the same. There's no difference other than voting rights. And yet now the A shares are trading at a 10% discount to the B shares, which is about as wide as it's ever traded. And I believe that's just silly. There's at minimum they should trade for the same value.
It's pretty recent that this gap has widened, right?
That's correct. Up until last year, they were within 1 or 2% of each other. Actually, back in 2015, I believe the A shares, the voting shares, were trading at a 10% premium because there were some takeover rumors. And so theoretically, if Diageo or some global company came in and said, we want to buy Brown Foreman, theoretically, the A shares would go from a 10% discount to a significant premium. And so at minimum, if you own Brown Foreman stock, you should strongly consider swapping from the B shares to the A shares. But for people that want a non-correlated look for alpha, there might be an opportunity in shorting the B shares and buying the A shares. Borrow is essentially free. I think it was 0.3% a year the last I looked in the B shares. So there shouldn't be any issues with running that as a pair trade.
Yeah, what hurts you there is just if it takes too long. It takes up a lot
That's
of
right.
capital, and yeah, the maximum gain is sort of limited.
That's right.
But I thought that was a very very interesting little idea.
But I previously owned B shares, and so it was an obvious decision for me this year to switch my B shares into A shares. So now I own more of the company and get more dividend at no cost to me.
Okay, and you didn't do the pair trade, or you didn't short the other one, or something?
No, I'm not short the other one.
Sure. Something else that you're invested in is Investors Title, a title insurer, and this is sort of a US specific thing, so I'm not too familiar with it. Can you explain what it is and why it's great?
Sure. Yeah, in the U.S., you're right. It's mostly a U.S. industry. When people buy or sell a property, they have the deed to it, obviously, and the system for maintaining that is not like in Europe. I believe it's all government run, but in the U.S. it's not. And so there's potentially legal liability if anything is wrong with the deed, like if there's a tax lien against a property or if there's some sort of damage, lawsuit, anything that's hidden, uh, the new owner of the house could face liability. And so banks won't give you a mortgage in the US typically unless you have title insurance because the bank doesn't want its collateral uh, to be impaired by some hidden obligation. And so whenever people buy a house, they pretty much have to buy title insurance. The banks just require it for mortgages. So you have a captive industry. Like anyone, if you want to buy a house, you have to buy this product. It's not a large portion of the overall price of a house, and so people aren't too cost specific. Like people don't care about price too much.
I
So you
think there
only have
are a
four.
few bills like that that happen during the purchase of a house.
What's that?
I think there are like a few bills like that during the
Yeah,
time of the purchase of a house that are
yeah, that's right.
sort of
And so
large, but not really in the context of purchasing your home.
yeah, and so I don't think there's a lot of pricing risk there. There's four major companies in the US that do title insurance, and it's been that way for decades. The specific one you mentioned, Investors Title, is not one of the large four. It's a independent company that primarily has operations in just two states. Family-run company. I think eventually it might be sold if the family gets tired of running it. It would be natural for one of the big four to buy it out, so that gives you upside there. That company's capital allocations over the years has been phenomenal. I believe the stock's been a 15 bagger over the past 20 years, and yet still at a small market cap now because it's just not a big business. It's trading at, I believe, 11 times earnings now. The price is still down 30% because people looked at it and said, oh, insurance, I don't want to own that during a crisis. But you look at the numbers that the banks are reporting, the home builders are reporting, the mortgage business is booming. And so it's a matter of time
So,
until
and
Investors
does
Title
this
reports.
kind of high insider ownership with like a founder owner or something like that?
Yeah, the family still controls the company. The float is very limited. The stock ran up 80% a month in 2016 after President Trump won because people realized housing was going to go up and there was so little float available that somebody just jammed the price from 80 bucks to 150. And I wouldn't be surprised if you get a big move when they announce record earnings in Q3 and Q4.
Oh, wow. And do you see any regulatory risk, like because it's sort of a bullshit expense, this
That's true.
title insurance, and maybe somebody is going to abolish it, or didn't happen in history, probably not going to happen.
I don't. I mean, it's always a long-term risk, but I'm not aware of anything that's in motion right now that would disrupt the system. I think the big risk to the thesis is just the economy double dips, housing slows down again. Like it appears more government aid is stalled out in the U.S. right now. Maybe nothing's going to get done until after the election, so maybe the housing market cools off quicker than we expect. Also, keep in mind it's an insurer, so they write policies, they invest the premiums in the market. They've made money this year because the stock market and bond market have gone up. But if the stock market goes down, they would lose money. I believe Q1 they had significant losses on their investments. And so, I mean, just if the economy goes sideways, they're going to the record earnings that I'm forecasting won't happen. That's the risk.
Right. Cool. And the last thing I was wondering about this industry, because you mentioned there are like 4 large operators and at least one independent one, maybe a few others, and you view it sort of as a cartel or a monopoly type business. How is that sustainable? Because it sounds like a good business to start.
Yeah, I think the issue is that the title insurers primarily get business from referrals. And so I think you have deep connections there between realtors, between banks, and between the title insurers. People are comfortable with who they've been working with. Maybe they get invited to each other's events. I think you just have a friendly network locally. And I think that's how Investors Title has succeeded in 2 states, but they haven't tried to expand very far outside of their network because they have meaningful market share where they operate. And I think it would be prohibitively difficult for them to try to expand elsewhere. Just because you would have to, I think you would just, if you wanted to disrupt the business, I think you'd have to pay all the agents a lot more money to leave where they were now, and that would destroy your profit margin.
Sure. So it's really expensive to build up like the local scale to get going and compete and
Yeah,
even
I'm
earn
not sure
something
what a
remotely close.
I'm not sure what a new title insurer would have to offer to the market that would make it stand out from the existing ones that have decades of experience working with the realtors and the banks and all the
Ye-
local
It's probably also
movers and
something
shakers.
where the other parties just want nothing going wrong and otherwise don't care to.
Yeah, I think it's that sort of business where you're only 5% of the cost of a product or something like that. And so as long as you provide a quality product and people know you're reliable, they have no incentive to shift. Like, oh, we can save 10 basis points of our total purchase price by moving suppliers, but if they screw up, then we're going to get sued. Like, that's not an attractive proposition.
Yeah, exactly. Cool. Um, Ian, those were super interesting ideas. I've been keeping you for an hour, so I'm going to let you go. But
Well, thank you. You had great questions. It was a fun discussion.
no, thank you so much for being on. I hope to get you back sometime in the future. Um, but please tell people where can they find your research server or reach out to you or find you.
Sure. The easiest to find me on social media is on Twitter. I'm at Bezek, Bezek, on Twitter. And then on Seeking Alpha, just look for Ian Bezek and you can find all my articles and my subscription service there.
Okay, so you've got a number of free articles out there that people can check out, and those will link to your research servers.
That's right.
Well, thank you so much for being on, and well, have a great evening.
You too. Thank you.
Bye bye.
Bye.